Everyone. On behalf of Asian Markets, we welcome you all to the 4Q and full year FY20 earnings conference call of Elgi Equipment Limited. We have with us today Mr. Jairam Vajaraj, Managing Director representing the company. I request Mr. Jairam to take us through an overview of the quarterly and the yearly results, and then we shall begin the Q&A session. Over to you, sir. Thank you.
Thank you very much, Kamlesh. And ladies and gentlemen, thank you very much for your time. Before we start, I hope that you and your family and all your dear ones are safe and well. These are trying times for us, and I think the entire solution for battling through this process is squarely our responsibility. And I wish you all the best in terms of continuing to practice safe existence and so that we are able to beat this situation. So having said that, as per our normal practice, I will take you through a reconciliation of our Q4 performance compared to Q4 of last year, and then talk about the full year, again in relation to the previous year, and give you a context for how the business has done, which are not necessarily fully reflected in the numbers. So if I compare Q4 of this year versus Q4 of last year, our revenue dropped by almost 733. In fact, at the minimum, we would have easily done this if not the shutdown around about the second or third week of March. We had all the products lined up. So we lost close to 750 million, 75 crores of revenue in the month of March. As a consequence of that, our EBITDA impact was close to 32 crores. And what was interesting for us this year is that our contribution margins have significantly improved. And this is not an anomaly, as you would have seen over the many years. We have consistently improved our contribution margin at the material cost level. So combining these two, the loss of revenue and the improvement in material cost, at a contribution level, we lost about 23 crores. Our EBITDA under these circumstances should have been about 38 crores, when in reality, we had only 21 crores. So there's been an impact, cost increase impact, impacting EBITDA to the extent of 17 crores. The largest impact of this has been our strategic investments in Belgium to the extent of 8 crores during the quarter, and the fact that we had made 3 specific acquisitions. One was Michigan Air in December. The cost of that comes in additionally as a cost. And we had the final earn-out payout in the case of Fulfords, and we took over the portable business of our distributor in the US. So the combined effect was that was the reason why we had a significant increase in our fixed cost. The regular business as usual costs were well under control. In fact, I will just step back here and talk about the third quarter. Up to the December quarter, for the 9 months, the Indian market was extremely challenging. We recognized it as early as August. Sluggishness had already set in. We went through a significant cost optimization program, as well as a different marketing, going deeper into the market, an aggressive marketing program. And the months of January and February, we were doing exceedingly well. And we expected March to be also a record month for us in India. But unfortunately, that didn't happen. So it's the combined impact of that and our strategic investments in primarily Belgium that has caused this impact in our EBITDA compared to last year. Going into year, at a full year level, our revenue drop is close to 34 crores. And if we had not had the impact of this virus, we'd have actually exceeded last year's revenue. And that's what I was telling you. January and February was tracking very nicely for us. And that unfortunately didn't happen in March. And because of the revenue loss of about 34 crores at a full year level, our contribution also dropped by about 15 crores. But like I said, our contribution margins have been very positive. And because of that, we gained close to about 32 crores. So net, we gained about 17 crores at the contribution level. At EBITDA, we should have been at around 210 crores. We came in at 130, so there's a gap of close to about 81 crores. And our biggest cost, again, it is similar to the Q4 explanation. Our biggest costs have been in our strategic investments in Belgium and in our acquisition. India, we had made an investment in people and in certain other fixed costs in the beginning of the year on the expectation there will be a close to an 18% growth in India. That did not materialize. So for a big part of the year, we had to incur the costs. We are reining those costs in now, both on the people side as well as on the other fixed costs. We started that process somewhere in November, December. That's why we saw some good impact of that in Q4. And that all those reductions, we are continuing to benefit even now. So this is really the summary of the numbers. I will, of course, take specific questions later. But I would like to step back and talk about our business for the year 19-20. What were the highs and what were the lows? So let me start with the lows first. The low for us was that, like I said, India started on a very positive platform. We were looking at everything pointed to a buoyant growth in India, and because of that, we had made certain investments to reach into new markets, which meant additional people. Unfortunately, that did not materialize, and because of that, there was a significant effect on us. Belgium investment, like I had explained to you in the past is a strategic, deliberate investment. In fact, today, what we are spending in Belgium is far lower than we had earlier budgeted, and the results that we are getting as a consequence of that has been very positive. So on the low side, it is really not a low, but it's an expense that I'm bringing in. US, again, there were certain additions to people because we took over the portable business, and there was a transitionary kind of a lull from the distributor to us. It is coming back up. So during the year, we had some dislocations, which we have picked up, and things are happening back now. That's a low. Patents, which was an area that we looked at close to 16% growth, did not do well. We have specific reasons. We are working on putting those solutions in place as we speak. But that was a low for us last year. On the positive side, on the highs, is that if you look at, again, Belgium, we have been able to add distributors in almost all the countries, and the rate of increase of distributors is extremely encouraging. And I will come and talk about what is the indication for us in April, May, and June. And in that context, I will talk a little bit more about Belgium. The positive thing, other highs are that in India, we have gained share of the market. In spite of a sluggish market, in specific verticals, we have gained share. But it was not enough to compensate for the drop in the market that we experienced, the overall demand drop that we experienced. So on the other highs have been new products that we have introduced. They've gained very good traction, especially in the oil-free segment in India, which is a very positive thing. We have grown very well in that segment of the market. Pulfords in Australia, that acquisition has done exceedingly well for us. We have grown there. So these are all the highs and lows for what happened on the business side. So as usual, let me give you a geographical rundown. Starting from Australia, we have done well in Australia last year. Pulfords and Elgi Australia combined entity has grown. We are continuing to increase our share of the market, so it's a very positive thing. Southeast Asia has also grown, but nowhere near what we anticipated, but there has been a growth. India has been a challenge for us, not because of our performance, it is just the general drop in the market, but specific verticals have done very well. Gulf, where we went through a direct model, while we have grown, we have not grown enough to the extent that we had budgeted. I'm not worried about it. It is not an issue with the market or our strategy. It is just a planning error in terms of how quickly we could have expected that kind of a growth that we had planned. In Europe, our regular business through Rotair of our industrial products has done exceedingly well, both in Italy and in France. And with the addition of the manpower that we have done to reach into Spain, into UK, into Benelux, into the whole Benelux region, Eastern Europe has also gained very good traction. We are beginning to see revenues beginning to ramp up. US, our direct business grew well, but not at the percentage that we expected. Overall market in the US dropped, but actually we grew when the market dropped, which means we have gained share in the market. Patterns, like I said, has been a challenge. We are on top of it. I'm very confident that we will come around. I don't think there is an area of concern there. As far as new products are concerned, our AB series, which is our new oil-free, disruptive oil-free machine, has seen exceedingly good traction in India. We have already installed machines in Europe as well as in the US. So this is a very positive thing for the future, and we are very confident, and the whole team is very confident, including our distributors all over the world, that we have a good product in our hand. We have launched a range of piston compressors, very high-tech, highly engineered solution, which will give us the ability to expand our share of the market in India, where there is a high domination of unorganized players with low cost. With our new technology and our machine, we are very confident that we can penetrate into these price-sensitive markets. So overall, while the financial numbers look very challenging, the business fundamentals look very solid. So I'm very confident that the future looks good. Now, I need to talk to you about the COVID situation. Now, specifically for us situated in Tamil Nadu, I'll give you a context of what happened. We were locked down by the 21st or 22nd of March is when the lockdown happened. We anticipated that April and May will be a washout, but contrary to that, we were able to get special permission from the government. We operated our plant with very skeletal staff, primarily to supply our overseas requirements, which we did, and therefore, in the month of April, the revenue was not zero. It was nowhere near the run rate, but it was reasonable. Then in May, when the lockdown lifted, our performance in international markets really has helped us. Many of the countries like Australia is almost running at the earlier run rate. Europe is contributing because they're starting from zero, and that's been very positive. US was not locked down as much as India was. Therefore, the US operations have also locked in. So the performance in May and in June has been very good. Again, I want to caution you, nowhere near the run rate, but considering the situation, considering what I'm hearing about the drop of other capital goods companies, we have done well, and that's primarily because of our presence in the international market. And this is something that's heartening for us. At this point in time, I'm not able to say whether we have grown April to May to June, we have continued to grow. At this point in time, I'm not able to say whether that trajectory of growth will continue into July, August, and the rest of the month. I hope it does. If it does, then within this financial year, we should be able to get back to our normal run rate. So this is something that we are waiting and seeing. In the meantime, multiple cost reduction initiatives have already started. We are seeing the results of them. We have seen it in April, May, and June, and we will continue to see more of them coming in. So this is really the situation as far as the COVID context is concerned. So I will pause here, and if there are any specific questions, I'll be happy to take. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star followed by one on your touchtone phone now. We have a first question from the line of Ravi Swaminathan from Spark Capital. Please go ahead.
Hi, sir. Good morning, sir.
Hi, Ravi. How are you?
Great, sir. How are you, sir?
I'm well, thank you.
Yeah. Sir, my first question is in continuation to your commentary on current trends in terms of demand. What is the kind of run rate which is there in the domestic market, say in the month of June or something out of sort? Is it like 40-50% of normalcy or higher than that? How is it?
You mean in the current context, Ravi?
Yes, sir. So, I mean, vis-a-vis the usual run rate in the domestic market, how is it currently? And if you can give a picture on the individual subsectors like infra, industrial, water well, which is relatively better off and which is relatively worse off? Okay.
So I'll try to give you a breakup of our percentages in relation to the run rate in some of the major regions, right? So in India, we are at around 55. I will take June as the latest because it's the best month of the three, yeah? And it's a clean month in the sense that there was no lockdown and our factories were functioning, yeah? Okay. So June is India is about between 55 to 60% of the normal run rate, yeah? Now, if I have to look at verticals that have contributed, very surprisingly, we thought it would be pharma, food, FMCG, chemicals. We thought these were the verticals that would continue to give us the business. But we were surprised to see even general engineering investing, right? So we have, unlike our expectation that these 5 industry verticals will give us a bunched kind of a demand, revenue for the month of June, it was actually quite diversified, right? So we also questioned whether this is pent-up demand from the past that is being backlogs that we are showing. There is a certain percentage of order backlog that has contributed, but there is also book and bill that we have done, in the month of June. Yeah, this is India. As far as Europe is concerned, we are at around close to 70% of our run rate, and both portables as well as our industrial machines. As far as the US is concerned, we are close to 75% of our normal run rate in all the businesses put together. And in Australia, we are actually above our run rate.
Got it, sir. Got it. And on a slightly longer term question, a lot of the compressors in India in the lower end system are Chinese imports. Given the anti-China sentiment which is prevailing both in India and outside India, is there a possibility a significant portion of that can be captured by us in the domestic market, given that we are very strong in piston compressor? And outside India also, if you can give a flavor, will be great.
So first of all, the presence of Chinese compressors in India at the moment is not a very significant presence. It is there, but it's not very significant, right? At the max, I would say it is less than 5% of the market. Yeah. So, and they are playing in really the low end, the bottom feeding, low performance, low price segments of the market, right? And they don't have the marketing reach and the marketing presence that well-established customers would expect in terms of service support and training and all that. So to start with, their presence is low. Now, in terms of this anti-China sentiment mushrooming into behavior, it is too early to say that it's a turn of a switch, everything will change, Ravi, right? How the world is going to react to China because of the virus, and how India and India's friendly countries are going to react to what China is doing in the borders, there are too early days to talk about, right? In terms of a permanent impact. I think it is going to take some time. The world right now is struggling to deal with the virus, right? I think it has to settle down before any strategic decisions and maneuvers are made in that direction.
Got it, sir. Got it. And finally, in terms of costs, so basically on a blended basis, both at an India level and outside India level, what kind of reduction would ultimately be in FY financial year 21? And also in terms of other costs, you had mentioned legal charges, etc., which might not be there going forward. If you can give some insight on, it would be great. Yeah. And CapEx plans also, sir. Yeah.
Our CapEx right now is frozen to, pretty much frozen, Ravi. So I don't think we are going to look at any fresh CapEx. If at all, there's going to be CapEx of residual payment, residual machines. I mean, residual payments on machines that have already been either ordered or have been delivered, and we have the final payments to be made. I don't see a significant amount of value there, right? As far as our goal is a 20% reduction in our overheads, right? It's too early to talk about what exactly we will achieve, but the entire team, the entire leadership team is their predominant focus is on looking at how to fundamentally reduce our cost. And I'm reasonably confident that we will achieve, because I'll give you an example. For instance, we are looking at shutting down most of our branch offices, and we're changing to a model of working from home, right? And there's a significant savings in rent. So these are all the things that we have already decided, and it's a matter of rolling it out, right? So, and every contract is being renegotiated, right? So where it will settle down, it is too early to tell, but there will be reduction. So our goal is 20%. We'll have to see how much we will achieve. Yeah.
Got it, sir. Thanks a lot, sir. I'll come back in a few if they have more.
Yeah.
Thank you. So we have next question from the line of Kirti Jain from Sundaram Mutual Fund. Please go ahead.
Thanks for the opportunity. So first is on the motor manufacturing thing which you are doing for Captive. For how many models or how much of our sales mix we have been able to adopt in-house motor? Second thing, on the aftermarket business, how has been the momentum in the Q1 and how is the inquiry levels for the aftermarket? And thirdly, are these cost reduction changes which you are highlighted in the earlier part to Ravi, are these structural or will they again come back in FY22 or FY23? Okay. These are the three questions, sir.
Okay. So, motor plant, like last year, the 19-20 was our investment as well as field validation program. We have got hundreds of motors running in India, and the performance has been outstanding of these motors. But unfortunately, this year, the first 3 months, the requirements have been low. So the motors are being supplied right now. We are focusing only on the India market, and in the limited supplies that we are making in the India market right now, maybe 25% of our compressors are going with our motors. We expect by October, we hope that percentage will go up to 55%, and then we will look at expanding it to Europe and in the US. So that's really the plan that we have. Your second question was pertaining to the overheads, I believe, right?
Aftermarket, sir.
Yeah, aftermarket. Yeah. So aftermarket in these 3 months has done well. Again, nowhere near the run rate of our earlier run rate, but it's been one of the larger contributors to our revenue in these 3 months, because a lot of plants are running, and one is our ability to supply, which we have built up fully now. We are fully geared up to supply. The other is many of the places are still under local lockdown, so customers want the service, but we are unable to reach them in some locations. In many cases, customers don't want us to visit at all, right? So there is all these combinations that are happening. It could have been a lot more, but I don't think we have lost any opportunity in terms of what is there in the market. And the third is in terms of overheads. See, if you look at all our overheads, there is the occurrence of the overhead and the cost of the overhead. Now, occurrence has come down by virtue of the current situation. That's nothing that we have accomplished. Our goal is to reduce the overhead at a structure level, right? So when I talk about 20% reduction, it is not necessarily focused. It is not fully focused on occurrence. It is focused on the structure of the cost. So I'll give you an example. Travel cost right now is almost zero. Now, that is no achievement of the management team. It's a situation that has created that reduction in cost. But we need to look at the structure of the cost itself. For instance, do we need to travel, right? That's a structural decision. So our decision to wind down our branch offices, move salespeople closer to customer pockets, these are all structural changes that will result in reduction in travel cost even after the situation comes back to normal.
Okay. Sir, now when we see the end markets, sir, two end markets which have seen some positivity is, food processing industry. There have been capex plans, and yesterday government also told new plans have been laid by government. Yeah. And second thing is on the pharma side, government is also providing a lot of incentives. Yeah. So anything we are bringing new products towards that side to gain traction and gain market towards that side, sir?
There is nothing new for food processing. We've had a very strong presence in that vertical and we are seeing that vertical contributing in these 3 months. So we're quite happy about that. There are no new products per se. It is just a more focused attention that we are paying. As far as pharmaceuticals are concerned, like I said, our new oil-free machine, our disrupted oil-free, has seen very good traction in this segment. And increasingly, we are seeing all the large pharma brands becoming our customers. So it's a very positive development there.
Thanks, sir. Thanks a lot, sir.
Thank you, sir. We have next question from the line of Bhavin Bitlani from SBI Mutual Fund. Please go ahead.
Hello, Jay.
Hi, Bhavin. How are you?
Very well, thank you. Hope all well at LG family.
Yeah. Good. Thank you.
So, Jay, it's more of a question like when we met last in Feb, and once the lockdown was initiated and the current situation, are you more positive or negative looking at the current developments?
Well, obviously, I'm not very happy with the current development, our inability to go and engage with customers. The positive side is that it is giving us a lot of opportunity to introspect and clean up many of our cost structures, right? As you're growing, you tend to incur costs because you're so caught up in that momentum of growth or developing new markets or new initiatives. So this has given us a good pause to reflect back and say, where do we take costs out, right? So that's been a very positive thing. The other positive thing that, our international business, even though it was contributing 50%, has always been a bit of a living under the shadow of the Indian business. Now, the fact that we have got, our performance in April, May, June, because of our presence in international markets, at a much better profitability, which is far better, is another positive sign for us to really push hard and grow those, right? I just want to say that, our break-even earlier, at the earlier run rate, we were at 80. Today, our break-even is at 60%. I mean, part of it is because our international businesses have higher profit margin. Part of it is also, because of the current situation, a lot of the overheads have gone away, right? So that is true. So our cost reduction initiative will address some part of the overhead reduction will get sustained. But the fact is the international businesses' higher profit contribution has been a very positive thing in these 3 months.
I understand. So we're just continuing on that liquidity support that you would have thought maybe sometime towards the time of April. Would you believe that the same is now required, or now you believe that the business has actually been back on the feet much sooner? That liquidity support.
Yeah, it's a fair question, Bhavin, but the point here is, yes, compared to what we planned would be the reality for April, May, June, we have done far better than that. There is no doubt about it. The expected impact on our liquidity that we had thought will happen, it has not happened. But my concern at this point in time is, will we continue to follow the trajectory of growth of April, May, June? If we don't, then we will face a liquidity situation, maybe not so as extreme as we thought we will, but if we are not going to grow quickly to our earlier run rate, there could be some challenges. So we are continuing to pursue options on enhancing liquidity. Still very early days to talk about anything specific, but we are giving it enough serious attention. It's a priority that we are focused on.
I understand. Just one last question from my side on the aftermarket you already addressed. But like within the population of the LG equipment that we would have installed, what would be our wallet share within that? And this is looking at some of your peers which may have a larger installed base, and 40% of the revenues come from the aftermarket. If you could give some color, maybe on a 3-year basis, as you said, it is a much larger focus market now.
Hello? I lost you there.
Sorry. So the question was on the aftermarket. One is,
I got that. The last bit I lost you. Yeah.
Okay. So the last, when we look at some of your peers like Atlas Copco, for them aftermarket share is about 40%. If you could give a 3-year to 4-year picture, maybe ignoring the current disruption, how the aftermarket can grow for us.
Okay. So let me contrast our aftermarket business in India, and that too for certain products that are aftermarket conducive, right? So let me clarify that a little bit more. So if you take an oil lubricated screw compressor, it's extremely conducive for an aftermarket business because these are organized customers who buy it. They need the service and support, parts and service and support. Then there are piston compressors that are not very conducive because these are small customers who don't really look at buying, repairing and maintaining their machine as per the recommended intervals. That's good for the machine. Then you have the portable business, where the aftermarket worldwide, it's not only for Elgi but worldwide, it is only the response of that market is very poor in terms of maintaining the machines to the schedules. Then you have the railway business, which is again government owned. The aftermarket piece is not as high as the regular industry. So if I take the industrial piece, which is the oil lubricated screw and the oil-free screw in India, and I take the segment where Elgi has got a good installed base comparable to the other brands that you mentioned, it will be the oil lubricated screw compressor. Now, if I take only that business vertical, and if I look at only the aftermarket piece of that business vertical, we are already at a mature 35-40%, right? So we are comparable at a global level of opportunity compared to the others in India for markets, for product segments where it is very conducive. Now, in the other markets for oil lubricated, our challenge and the opportunity is to create that install base. The minute you create that install base, you have a regular flow of aftermarket. Now, just to give you an example, just to give you a reference point, just on parts, I'm talking consumable parts, without taking into account the opportunity in the replacement parts, without taking into the opportunity in the service charges. I'm just looking at consumable parts. If $1 of equipment sale is made, you have $1.2 of contribution level profit over a 10-year period from just consumable parts. So that's the profit opportunity of the aftermarket at a very, very conservative level. So which really means that, 12% even in the first year on the equipment sale you're going to get as aftermarket. And as the install base keeps going up, this becomes an annuity that will come.
Understand. And so what could be the aftermarket as a percentage of our India business
at today's level, if you combine everything as the denominator, all the businesses and the aftermarket as the numerator, we are at around 24%, right? But if you take specific industry verticals, like I said, in some of them we are at 35-40%.
Understand. Yeah. Thank you so much for taking my question and best wishes from our side.
Sure. Thank you.
Thank you. A reminder to participants to ask a question, please press star followed by 1 on your touchtone phone now. We have next question from the line of Manish Goyal from Enam Holdings. Please go ahead.
Yeah. Hi, Jay. How are you?
Good, Manish. How are you?
Good, sir. Thank you so much. Just to continuing from what Bhavin was asking, like earlier when we had met in February, so we had enumerated in terms of like the number of people we are looking to add in Europe and then associated cost implications over a period of next 3 years to the tune of some 160 odd crores. So with evolving situation, with things changing, so if you can like give us a perspective, like one is on your expectation on the revenue front, how has it changed? And on second, on the cost front, going forward, how has it changed? If you can just give us a perspective on Europe and overall as well.
Yeah. So on our Europe strategic plan, when this crisis hit, all the additional headcount increases have been frozen, right? Now, to what extent we have reduced in relation to that 160 crores that we had planned to invest over a 3-year period, I would say about we have cut off probably around 20% of it, 20 to 25%. Yeah.
Okay.
And we are going to wait and see if the market starts moving and we are able to deliver on the numbers, then we will incrementally add. And these are all revenue producing headcount. These are not overheads. Yeah.
Right.
As far as the sales are concerned, this period is not the right period for me to make an assessment. But if I look at April, even earlier, if I go back to even January onwards, except for the period where Europe was locked down, we have consistently grown our sales of the Europe initiative in every country, right? So I don't want to give specific numbers, Manish. We had a run rate of our machines already in Italy. We already had a run rate of our machines in France. I'm not talking about that, even though it's part of that initiative, and that cost that we are incurring is actually propelling additional sales in these 2 countries. I'm not even talking about those 2 countries. I'm talking about all the new countries that we have gone in. We are seeing significant increase in revenue. Yeah. But nowhere near what we had earlier projected because of the current situation. But considering the current situation, what we are doing is a very positive thing for me.
Okay. So ideally, the seeding of the market, which we were probably planning now with the hiring of new people, is it that it probably gets postponed by a year or so, and the incremental sales what we were probably looking may probably materialize, but at a lower end?
So the annual cost that we had earlier planned as part of that 160 crore investment, the 160 crore investment is actually a loss, right?
Right.
So the people cost that were contributing to that loss, I'm saying 75% is already baked in. Yeah. They're already there, right? It's that additional 25% that we would have spent more on adding people that has been frozen. Yeah.
Okay, got your point. And also taking it forward from here, like our annual employee cost is roughly 400 odd crores. So when you said we are probably looking at 15 to 20% cut in cost, can we expect similar number over here, or how should we look at it?
The reduction in cost outside India is not going to be significant because these are all recent additions for a very small business, relatively speaking. Yeah. There are some increases we have gained. For instance, we have participated in the payroll protection program in the US, and we have got a grant of close to $2.5 million, right? Now, those are all government-supported effective reductions in our people cost there. Yeah. Similarly, in Australia, there is a paycheck protection program. We have been eligible and we have got about $1.5 million, right?
Okay.
Now, those are all going to be cost reductions of a temporary nature in these high-cost economies where the number of people is already less. If we cut anything further, then that business, whatever business we are doing, will go. Yeah.
Right.
So the focus is on India. Yeah. Now, India, we invested with a certain expectation of growth, but it's not because of our performance of the team. It is the economy that started tanking from August of last year, right? So we are taking cognizance of that and then saying, what is it that we need to take out? Yeah. And under these circumstances, we have to do it in a very humane way. Yeah.
Right.
We have to be conscious of our costs, but we also need to be conscious of the lives of people and their family, right?
Yeah.
So it is a fine balance that we are working on. Yeah.
Okay. And just needs a couple of housekeeping questions in terms of what is our gross debt and net debt as on March?
So the net debt as on March was about 260 crores, right? Then I don't have the gross debt. Unfortunately, Manish, working from home, I don't have easy access to information, right? But I can share this offline with you. I'll have Raghu send that information.
No problem. Thank you so much. Just one more question.
But I can tell you the net debt right now is lower by about 50 crores.
Right now, as on date?
Yes.
Wonderful. And just last question, I wanted also a data point on other income which has shot up in standalone in Q4 to 30.6 crores. So is it that dividend from the automotive subsidiary has come in?
No. So we did not take any dividend from ATS. Like I explained in the dividend decision that we had made in February, March. See, this year there was a one-time provision that the tax paid by the subsidiaries, overseas subsidiaries, if they pay a dividend, the tax could be set off in India only for the financial year 19-20, right? So these dividends came from our Indonesian and our Gulf subsidiary.
Okay.
We did not take dividend from ATS.
So this is basically a reversal of tax which is paid on the dividends received from Indonesia and Gulf subsidiary.
Correct. That is that 30 odd crores that you see as other income, right? Now, in the consolidated, you won't see it because it's within the thing, it's consolidated, right?
Right.
And the tax on that has been taken out of reserves because when you consolidate, you don't have income, but you have to pay tax, correct?
Sure.
So just like dividend distribution tax, which is taken out of the reserves, this has also been taken out of the reserves.
Okay, fine. Thank you so much.
Yeah.
Thank you, sir. We have next question from the line of Ranjit Sivram from ICICI Securities. Please go ahead.
Yeah, hi sir. Good morning.
Good morning, Ranjit.
Yeah, sir, this employee cost of 400 crore, how do you see that? Okay, we understand that given the scenario, is it like we will stop any incentives and bonuses and keep our workforce for the long term? So will that sustain around the same number or you see a reduction in that?
We are working on reducing that, like I just explained to Manish. The focus more is on our India headcount, because the headcount in outside of India is very small, and if we touch that in any significant way, it's not that we are not going to, but if we do touch it in any significant way, it's going to paralyze our business there. So it's an India-focused thing. So in India, what we have done is there are no increments for this year. There is no performance bonus for this year. And we are also looked at the first level, for as a first stage of cash flow optimization for certain levels of people and above, we have deferred a certain percentage of their salary, right? Now, we are going to watch this very carefully to see whether we should go to convert this deferral into a salary cut. We will take that call in the next couple of months. This is on just optimizing the cost, but there we see opportunities to reduce the headcount. Like I said, we had invested in India on the premise that the Indian economy will continue to grow, and we had invested in people last year, and that has not happened. The Indian economy did not grow. It's not that we didn't perform to that potential. So we don't see the Indian economy coming back to the growth path of 7, 8, 9% anytime soon. So therefore, there is an opportunity for us to look at these costs, which is what we are evaluating. That will be a reduction in the cost.
Okay, and what's our target for debt for the full year? Is there anything in our mind? Sorry, I lost your question on that, Ranjit. What's our target for debt for the full year? Any target?
If we had done to our budget, which is close to a 15% growth, then our debt levels would have been half of what our current level is. But I'm not able to say how our top line, because without a top line, there is absolutely no way we can manage our debt very well, right? Under steady state conditions. So, like I said, right now our debt has come down. We have managed our cash flow very well. The debt has come down. But if the top line doesn't support and grow, it's going to be very difficult to sustain it at these levels, right? So, to Bhavin's question earlier, I said we are looking at other forms of funding which will help us during this time, but we are evaluating what could be the scenario that we need to plan for, right?
Okay. And sir, in the, I think in one of the major segments, the water well, last year we had lost some market share. Yeah. So, has that seeing any improvement? Because we are seeing at least the farm sector is doing well. The number of hectares which are being...
Yeah. Farm sector is certainly doing well, but the water well segment has not picked up yet. We have lined up some great products for that market. Very optimistic about when this market comes back, we are going to regain our share of this market. This time I'm very confident because the products that we have developed are just outstanding. Now, is it going to happen in 1 year? Probably not. But in 2 to 3 years' time, I'm very confident we'll regain our dominant position in that segment.
Okay. And sir, lastly, you seem to be a bit more optimistic compared to our last con call. So, if you can say which segment, like, okay, you told it's a broad diversified. In that, if you want to pick up 2-3 particular segments, which are the ones which are driving this optimism?
So during the last call, which was sometime in April, we were kind of just in the at the start of this entire pandemic and the impact of it. And nobody really knew what was going on and what to expect because nothing was happening on the ground. But in the 3 months of April, May and June, we have got a little bit more confidence that the future may not be as bleak as we thought it could be, right? But still, I want to caution here, it's early days. Like I said, the trajectory of growth has been very good in April, May, June. Whether it will continue down that trajectory for the balance 9 months is something that I'm not able to say for sure. So with that caution in mind, the positives that I see is our international business has really done well, right? The drop in the run rate in our international market has been significantly lower than the drop in the run rate in India, right? So the verticals that have done well in international market cuts across all. It is not specific to any specific industry vertical. We are seeing it across. In India, we anticipated only these 5 segments, which is chemicals, pharmaceutical, food and beverage, FMCG, and textiles. These are the things we thought will continue to have a good run rate. But what we are seeing in the 3 months, we're seeing a much more broader spectrum of industries buying our machines.
Okay. Okay, sir. Thank you, and all the best.
Thank you.
Thank you, sir. We have next question from the line of Aditya Bagul from Axis Capital. Please go ahead.
Thank you. Good afternoon, Jay. I hope everyone at LG family is doing well.
Thank you. Yes.
Great. So, sir, my question is on a slightly longer term basis, that too with respect to our overseas business, right? We have five key geographies where we operate. We have Middle East, Southeast Asia, Australia, Europe, and US. On a sustainable basis, can you help us understand what is the kind of growth rates that we expect in these geographies? And if you could probably split that between what is the overall industry growth rate and what is it that we are targeting?
Okay. So strategically, our markets are Australia, Indonesia, Thailand, India, Europe, and the US. These are our strategic markets, Aditya. So if I look at Australia, the Australian market is probably growing at less than 1%. But our growth rate is I don't want to give the exact percentage, but it's double digit, right? It's a low double digit. Now, why is that happening? When you're a bottom feeder, I keep giving this anecdotal thing as a reference. When you're a fish at the bottom on the floor of the ocean, if there is a storm at the top of the water, it doesn't make a difference, right? So there is so much of headroom for us to grow, right? So that's really what is happening for us in Australia. Now, we have a very clear plan to double our revenue in the next 3 to 4 years in Australia, right? So, and we are tracking to that plan. We are very confident that will happen, right? Now, as far as India is concerned, Indonesia and Thailand, we continue to have challenges. It's more a talent level challenge rather than a market level challenge. We have grown, but our strategic traction is still not as strong as it's in Australia. We are working on that. India, I've explained it over again in this call. We are present, we are there. We have got multiple initiatives running in spite of the, a suppressed market. I'm not talking on a run rate basis. I'm not taking the COVID situation. I want to keep the COVID situation out. We are working on multiple initiatives to deepen our presence and our penetration into the market. We are quite confident that we will start seeing results in India. But the growth will be, a percentage of growth will be a function of how the economy supports us. This is something that we don't have any visibility into as to what is going to happen. As far as Europe is concerned, like I explained in the past our investment, we are talking about 160 crores over the next 3 to 4 years. Now, at the end of the 5th year, we expect to break even, recover our losses, and post a profit. And at that point in time, we are looking at a revenue of close to 500 crores. And that's the plan. And if you really look at, if we had to acquire a business of that size, it would have costed us probably more than double of what we are investing to grow that business, right? As far as the US is concerned, we worked with BCG 2 years ago to build a very clear strategic plan. We are tracking to that plan, and our goal is in the next 4 to 5 years, our combined revenue in the US will be close to $120 to $140 million. So that would be another. I have to convert it into rupees, which is close to 700, 800 crores.
Understood. That's quite helpful, sir. So, sir, my second question is on some of your opening remarks, right? You mentioned that in Q4 specifically, you had a revenue drop of 75 crores. But then in the same breath, you mentioned that your EBITDA impact was about 32 crores.
Yeah.
Is that
so? This is on Q4, right?
Yes. Yes.
So we lost 74 crores, and the contribution that we lost was 32 crores because of that 775 crores.
So this was on the contribution.
Contribution level, yes. And we gained contribution because our contribution margins at material cost level was higher than the previous year.
Understood. That's it from my end. Thank you so much, sir, and best of luck for the quarters to come.
Thank you.
Thank you, sir. We have next question from the line of Harshit Patel from Equirus Securities. Please go ahead.
Hi, sir. Thank you very much for the opportunity. Sir, my first question would be, sir, you have spoken at length on your plans, on your expansion plans into Europe. Sir, could you tell us what is the amount that you have already invested in FY20? I think earlier you had indicated about 30 crores kind of a number. So could you give us an update on that?
So our investment has been about 30 crores right now in the year 19-20.
Sure. And the overall revenue earned on these investments will be very minimal, I would expect.
It will be marginal for 19-20, but like I said, we are beginning to see a good growth happening from January onwards.
Sure. Sir, and on my second question, sir, I would expect that overall India's air compressors market would be around 4,000 to 4,500 crore kind of a number. So, sir,
I didn't hear you very well.
Sir, I would think that India's overall air compressors market would be around 4,000 to 4,500 crores. So, sir, out of this market, what would be the share of oil-free market? If you could throw some light on that.
I have numbers. I don't have the value. I know the numbers of machines. I don't have the value in front of me straight away.
So, sir, even if you could give us some idea on the volume.
Sorry, I'm not able to hear you very well. Can you repeat that, please?
Sure. So even.
Mr. Patel, I'm sorry to interrupt. This is the operator. Please, you'll have to put the fan or anything, the device that is in the background off, and you have to use the handset. There is a disturbance from the background. Thank you.
Is this better?
Yeah, much better.
Yes, better.
Sure. So, sir, even if you could give us some idea on the volume front, as you say, you have the overall numbers in front of you, then it would also help us a lot.
So, our estimate is for the year 19-20, the total market number of machines was approximately around 300.
Sure. And what would be our share, if you could highlight? I know it's a bit.
Our share would right now be about 20%.
Sure. And sir, globally, how would be the dynamics? I mean, globally, overall oil-free market would be greater in size than the oil lubricated one?
No. Our estimate of the global oil-free market, which includes both oil-free screw and centrifugal, is anywhere between 20 to 25% of the total air compressor market.
And total market would be around $15 billion?
Yeah, correct.
Approximately?
Correct.
Sure, sir. Perfect, sir. Those were the questions from my side. Thank you very much, sir.
Thank you, sir. We have next question from the line of Aman Shah from GTA Investments. Please go ahead.
Good afternoon, sir.
Good afternoon.
Sir, in some of the earlier interviews, actually, you highlighted that in the era of COVID, people will now look to maybe players like Elgi who give a better value proposition in form of quality as well as price, and that should sort of be beneficial to us in this era, actually. Would you please elaborate on that, and how are we seeing in last 2 to 3 months?
Yeah. So the fundamental logic is that under these conditions, everybody is looking at managing their cost and cash, right? Now, which means that when you're buying a compressor, earlier you may have bought a compressor. A compressor, like I've always explained, is not a production machine. It is not a machine that earns the customer money. It's a utility that supports the production in a factory. Now, typically people don't pay too much attention to the purchase of a compressor, right? But under conditions like this, earlier they may have just bought it on the basis of a brand and a little bit of negotiation and say, okay, fine, let's just do it, focus on the production. Conditions like this, brand, as long as it is competitive, if it is not, I don't think people are going to pay a premium just for the brand. Or the premium that they're willing to pay will be significantly lower. So that's the logic from a pure customer behavior point of view. So on that basis, we believe that there will be opportunity. Is it going to transform and make a switch overnight? No. And to answer your question, are we seeing this result in April, May, June? No. It's too early. And the impact we will see more in countries like Europe, America, and Australia, where we are not a known brand, but our performance is as good, if not better, than the well-known brand.
Right. So my second question was, we developed a revolutionary product on the oil-free compressor where we shrink the inefficiencies to just 5 to 7%. So my question is, in case we are competing with all the global leading compressor players and the market is very mature, the R&D budgets are much higher than us. What sort of keeps this growth perpetuating over a level? Because in case tomorrow even they would be putting all their efforts in revolutionizing their products. So in case so it will be a constant catch-up game on both sides. But what will be our perpetuating growth strategy actually, sir?
No, let me rephrase your question to the extent that I've understood. Are you saying how is it that we are able to develop these products in spite of not having a big R&D budget? Is that your question?
That's true, sir. Okay.
Now, this R&D as a percentage of sale is a very tricky number. Yeah. So if you take one of our competitors, they may be spending 2 to 2.5% of their revenue on R&D. Now, we are also spending around about 3% on R&D. Now, but you got to understand the cost of their people, which is also calculated into the R&D spend, is probably 5-6 times more, right? Than what we pay to our people, our engineers here, right? So if you factor that in, our R&D percentage on revenue is not 3%, it is significantly higher, right? In a normalized sense, right? So that is one part of it. The second part of it is innovation is not the domain of only large companies. In fact, innovation happens more. If you look at all the literature of innovation, it is small individuals and small companies that are more agile and innovative, right? Now, large companies, if you look at the failure of large companies, it is because you look at the classic case is Kodak. They were so, even though they came up with a digital camera, their revenue was so much dependent on selling these film cartridges, they didn't move to digital cameras, right? So large companies have the disadvantage of their installed technology, which is earning a lot of profit. To break it is a big thing, yeah. So it's not that large companies are more innovative. History has shown repeatedly breakthrough innovations come from individuals and small companies.
Right, sir. So that's all from my side. Thank you.
Yeah, thank you.
Thank you. Ladies and gentlemen, that was the last question. I'd now like to hand the conference over to Mr. Kamlesh Kotak from Asian Market Securities for closing comments. So over to you. Mr. Kotak, your line is open.
Hello.
Yes.
Jai, couple of points I just want to understand. In railway business, did you see any material change way up or down because of the current situation that is prevailing?
Oh, there is definitely a pause there, Kamlesh, because I think the government is also evaluating their budgetary allocation to deal with the financial situation in the country, right? So it's still early days to see how much of the railway budget is going to get, cut so that they are able to release funds for to handle the current situation, right? They've cut the defense budget, they've cut a lot of other budgets. In railway, we're waiting to see. Therefore, there is a pause. So we don't know whether they're going to continue to make that investment.
And same way in the other two pockets which were still in pain, construction, mining and automotive. Yeah. Do you see that the pain will be elongated and we may see the recovery only the next year?
What we are seeing is interesting. Construction, mining, there is some activity starting now. Yeah.
Okay.
There are some specific verticals like mining specifically, right? Where where there is a government conversations about allowing private mining. Yeah.
Yes.
For all minerals. So we are seeing some mining related businesses picking up. Yeah. But construction, of course, is very, very low.
Okay. Right. Great, sir. Okay, sir. So thanks for this very elaborate and insightful discussion. Participants also thanks for attending the call. Any closing remarks, sir, you want to make?
Nothing specific, Kamlesh. Thank you so much as always, for organizing this. It's I've tried to be as candid as possible, but the current circumstances are so fluid, and we will try to reach out as much as possible when material events happen. We will try to reach out to the investor community to communicate and share our thoughts.
Right. Great. Yeah. Appreciate the same. Yeah. So with that, we conclude the call. Thanks for
Thank you so much.
attending. Have a good day.